Welcome to the deep dive. This is where we take that huge stack of sources you give us and we really pull out the surprising, the actionable, and yeah, often the pretty ruthless ways power works across centuries, really, shaping the world you see today.
Exactly. And today, we're tackling something pretty big, looking across time. We're starting way back with the Gilded Age tycoons.
Yeah.
You know, the ones building massive empires in oil and steel.
Right.
Then we move to the financial wizards who figured out how to leverage those empires. And we end up with the Silicon Valley giants who are, right now, building the future on data and algorithms.
Yeah, it's a deep stack, definitely challenging. We've got sources covering the big monopolists from the 19th century. Think Vanderbilt, Carnegie, Rockefeller, their foundational moves, sometimes mythical ones.
Right.
Then we jump to the 80s, the high-stakes finance wars, like the RJR Nabisco LBO battle. Wild times.
Oh, yeah.
We'll also look at some sobering data on global wealth inequality today and finish up looking at the huge disruption that's coming, or maybe already here, with artificial intelligence.
And our mission, really, is to connect the dots. We want to map out the fundamental strategies, the ones that last, whether you're cornering the railroad market back then or, the internet market today. It's about understanding those constants, how relentless, efficient power actually works.
Exactly. What are those universal rules for building and holding on to a giant empire, whether you measure it in oil barrels, steel tons, or terabytes of data? Okay, so let's dig into this.
So the foundation for any huge fortune, old or new, really starts with getting rid of the competition, or at least pushing them to the side. The old masters, the industrialists, they were absolute experts at this, often using this kind of dual approach. Really ruthless in public, but also pretty sophisticated with legal tactics behind the scenes.
In the classic example, you have to start with Cornelius Vanderbilt. Everyone knows that supposed note, right? Super short, super aggressive, ending with, you have undertaken to cheat me, I'll ruin you. Yours truly, Cornelius Vanderbilt.
Right, it's the perfect image of that Gilded Age strongman. Like a guy totally above the law.
Exactly.
And that's why it's important, as the sources point out, that the note is almost certainly a myth.
Oh.
It only showed up in his obituary like decades later, probably cooked up to fit the image people already had of him. The real story is actually more revealing about how power really operated back then.
How so?
Well, first, he never signed off yours truly. His style was much more formal, like your obedient servant.
Ah, okay.
But more importantly, he wasn't above the law. He used the law constantly. He was suing people his entire adult life, apparently starting way back in 1816.
So the ruthlessness was real, but it wasn't just smashing things. It was also using the courts strategically, like weaponizing the legal system.
Precisely. He didn't just try to crush competitors directly. He'd tie them up in court. And think about it. Even if the lawsuit wasn't a guaranteed win, the process itself, well, it could bleed rivals dry.
Right. Legal fees, management time.
Exactly. It forces them to spend resources fighting in court, paralyzes them while he keeps doing business. The slowness of the legal system actually became an advantage for him.
That makes sense.
And this points to a specific mindset Vanderbilt and his circle had, kind of rooted in older business ways. They didn't really see a big difference between the company itself and the people who owned the stock.
Interesting. How did that play out?
Well, there's an example when the Pacific Mail Company was liquidating. Vanderbilt's guys insisted that the promise not to compete in the future had to come from the individual directors personally, not just the company.
Because the company was dissolving anyway.
Right. They knew the corporate entity was disappearing. For them, the real power, the real accountability, was with the person, not some abstract legal shell.
That's a really interesting contrast with someone like John D. Rockefeller, who was all about systemic dominance, building an empire that felt less personal, maybe more like a cold controlling machine. Standard Oil.
Yeah, and his empire wasn't just built on money. It was often built on technical superiority.
Okay.
Take Henry Rogers, one of his key guys. Rogers had this deep technical understanding, and he patented key processes, like a really efficient way to separate naphtha from crude oil.
So that locks down the market not just with ownership, but with know-how that competitors legally couldn't even use.
Exactly. Technical control. And then came the really predatory tactics that cemented the Standard Oil monopoly. There's that infamous story, pretty chilling, about John Ellis and Company, an independent refinery.
What happened to them?
Well, suddenly, Ellis starts having these strange, unaccountable shortages of vital supplies. Couldn't get the railroad cars they needed to ship their product. Things just stopped working for them.
A coincidence?
Not likely. The siege was total. Then a Standard Oil representative just casually shows up at Ellis's office.
And says,
basically lays it out. You are helpless. You will have to sell out. See, the real ruthlessness wasn't just price wars. It was controlling the adjacent stuff, the infrastructure everyone needed.
like the railroads, the supplies.
Yeah, a model you definitely still see today, maybe with tech platforms controlling access.
And Rockefeller himself, how did he manage this beast?
He was described as a kind of grand ventriloquist, operated at arm's length, relied heavily on experts, both for the business side and later for his huge philanthropic efforts. But his core obsession, beyond just control, was efficiency.
Efficiency.
Absolutely. Even with charity, which sounds weird. There's that famous story about thrift.
Oh, yeah?
Rockefeller found out a big donation he'd made, like $100,000, to a Baptist society. He was just sitting in an account, not earning any interest.
Okay.
He was apparently horrified, claimed he can't endure to see that money idle. So what does he do? He borrows the money back from the society himself and pays them 6% interest on it.
Wait, he borrowed his own donation back?
Yeah, it wasn't about needing the cash. It was the principle that money had to be working efficiently. It shows this deep-seated need for control over how capital flows.
Oh, that's something. And even these giants, they were competitive with each other, right? Carnegie?
Oh, intensely. Andrew Carnegie, the steel guy, he apparently got really frustrated with Rockefeller in private. Sources say he'd call him Rockefeller, or even Rockefeller in letters.
Why the frustration?
Carnegie was apparently vexed that Rockefeller had shown better foresight getting into the iron ore business and securing critical resources way before Carnegie realized how important it would be.
Yeah.
Competitive jealousy, pure and simple.
And Carnegie had his own tough strategies, especially with labor.
Definitely. During the big Homestead strike, his instructions to H.C. Frick, the guy running operations, were crystal clear. Break the strike. He said the payment for security, the fee for protection, needed to be overwhelming.
Why overwhelming?
To ensure, in Carnegie's words, that the discontented beat your protective forces. The goal wasn't just to win the strike, it was to crush the opposition so thoroughly that it would deter anyone from trying again for a long, long time.
Just brutal efficiency again. This relentless drive, sometimes it even seems to override basic financial logic, like with Howard Hughes and taxes.
Yeah, Hughes is a fascinating case later on. He had this almost pathological obsession with avoiding taxes. It wasn't just about paying less. It seemed like the act of avoidance itself was the goal.
How did that manifest?
Well, the source gives a specific example. Hughes would apparently consistently pick a deal that made, say, $5 million profit, but only cost $2 million in tax, over a different deal that would make $10 million profit, but cost $4 million in tax.
So he'd take less overall profit just to pay a smaller percentage in tax.
Exactly. The absolute amount of profit seems secondary to minimizing the government's cut. It's like controlling that aspect was more satisfying than maximizing his own wealth. It's about control again, isn't it?
It seems to be a constant theme, and Hughes also controlled things through chaos.
Right, deliberate organizational chaos. He'd apparently give conflicting instructions on the same deal to, like, 3 different employees.
Why would he do that?
To play them off each other, keep everyone guessing, slightly off balance. Ensure that nobody below him ever had the complete picture. As the source puts it, eventually, truth faded into the background. It's an incredibly effective, if maybe paranoid, way to maintain absolute central control.
So whether it's Rockefeller controlling logistics, Hughes creating chaos, or Vanderbilt using the courts, the early playbook seems clear.
Yeah. Eliminate rivals by controlling essential resources, whether it's railroads or information, and control the flow of capital with ruthless efficiency. That's the foundation.
Okay, so now I make a big jump. We're moving from, the gritty industrial age of steel and oil into the fluorescent lit boardrooms of the 1980s. This marks this huge shift towards the financialization of corporate power. And here's where it gets really interesting.
Yeah, this is a different world, and the absolute classic case study here is the RJR Nabisco leveraged buyout battle, the LBO war in the late 80s.
Right.
This wasn't a fight over railroad tracks or patents. This was fought with, well, financial engineering, specifically high-interest debt.
We should probably break down what an LBO actually is because it's key to this whole era. A leveraged buyout.
It's basically buying a company using a ton of borrowed money, right?
Exactly. But the really crucial, maybe cynical part is how that debt is secured. Usually it's secured against the assets of the very company you're buying.
So the buyer is using the target company itself as collateral.
Yeah.
All the risk gets loaded onto the company being acquired.
Precisely. And the money often came from junk bonds. We should explain those too.
Right, jump bonds. These are bonds that pay high interest because they're high risk. They're rated below investment grade by the agencies.
So riskier bets.
Definitely. And the firm Drexel Burnham, especially Michael Milken, became the absolute powerhouse because they specialize in funding these aggressive LBO deals that traditional banks wouldn't touch.
And Kravis KKR, who eventually won the RJR deal, they were backed by Drexel.
Yep. Even though Drexel was already under a huge cloud at the time, the Ivan Brzezicki insider trading scandal was blowing up, and there were serious rumors Drexel itself was about to face indictment over how they handled these deals.
Wow. So the risk tolerance was just off the charts. And this created a real clash of styles, right? You had guys like Ted Forsman.
Yeah, Forsman Little. Ted Korsman tried to take a moral stand against it all. He famously declared, no junk bonds, no bridge loans, no hostile tender offers, none of that crazy shit. He believed in, old school value creation through operations.
But could he stick to that?
Well, that's the thing. The lure of leverage, the sheer size of the potential winnings, was so strong that even Forsman's own bankers started trying to figure out ways around his stance.
Seriously?
Yeah, suggesting ways to kind of sneak junk bond elements into the deal, find loopholes. It just shows how much the whole environment had shifted. Leverage wasn't just a tool, it was becoming the tool.
The pressure must have been immense. And these deals involving billions, the commitments themselves were sometimes shaky, weren't they?
Oh, absolutely. The sources mentioned one of the major bids in the RJR fight from First Boston basically got tossed out pretty quickly. The committee reviewing the bids thought their crucial monetization letter was, quote, laughable.
Laughable for a multi-billion-dollar commitment. Why?
Because the letter, the thing supposedly guaranteeing billions in funding, it was just this flimsy letterhead from a tiny Citibank branch office.
Where?
On Mamaroneck Avenue in Harrison, New York. Just some suburban branch. And signed by only a vice president.
Not exactly confidence-inspiring for that kind of money.
Not at all. In a deal worth tens of billions, you need serious institutional weight behind the promise. Who signs it, which part of the bank, it all matters hugely. It just proved that finance, especially at that level, runs on trust and perception as much as numbers. That letter didn't have the right feel.
This whole era really solidified the power of private equity firms, players like Blackstone, but there's still a big debate about where their profits actually come from, right?
Yeah, a huge debate. Critics, and that includes some big institutional investors who actually put money into PE funds, they argue that maybe up to 75% of the value created since the early 80s isn't from brilliant management.
What is it from then?
They say it's mostly just two factors. Falling interest rates over that period, which makes debt cheaper, and just the massive amount of leverage the debt itself that PE firms use.
So financial engineering more than operational improvement.
That's the criticism.
Yeah.
But there's a counter-argument. A study done for the European Parliament, for example, suggests only about a third of the gains come directly from leverage.
And the rest.
Proponents argue the rest comes from genuine improvements.
Yeah.
Making companies more efficient, better management, long-term value growth. So are they financial engineers or are they actually better managers? The jury's kind of still out, or at least divided.
Well, Blackstone certainly seemed to nail the financial engineering part in real estate. That average 36% return by 2006 is staggering.
And they did it with a very specific buy and sell strategy. Get in, optimize quickly, maybe load up debt, and get out. Flip it.
Which is totally different from traditional real estate firms.
Completely opposite. Traditional firms often hold properties for the long haul, focusing on steady rental income. Blackstone's approach was about maximizing the return on capital velocity, how fast you can turn the money over, not just maximizing stable income.
And this whole financialization trend, this focus on leverage and rapid returns, it's had massive consequences for wealth distribution, hasn't it?
Profound consequences. Just look at the U.S. data, analyzed by economists like Thomas Piketty. Since about 1980, there's been this incredible shift in national income. Something like 15 percentage points of the total national income has moved from the bottom 90% of the population up to the top 10%.
15 points. That's enormous. That's not just random fluctuation.
No, it's structural. And the concentration at the very top is even more stark. Between roughly 1977 and 2007, the richest 10% basically captured 75% of all the economic growth in the U.S.
3/4 of all growth.
Yeah. And the richest 1%. They took home nearly 60% of that total growth. Meanwhile, for the bottom 90%, income growth basically flatlined. Less than 0.5% per year increase. It shows a fundamental break, really.
And you mentioned tax policy plays a role in cementing this. How does that work?
A key part is how different types of income are taxed. There was a study in France around 2010 that showed this really clearly. When they looked at the overall tax rate people paid all taxes combined, it formed this kind of bell curve, but with a twist at the top.
A bell curve, meaning most people in the middle pay the highest rates.
Sort of. It showed the bottom 50% paying maybe 40–45% total tax rate, but then the very, very top, the richest 0.1%, their overall rate dropped back down to only about 35%.
Lower than the bottom half. How? That seems backwards. It's regressive at the top.
Exactly, regressive at the very top. The reason is largely down to capital income. Earned income, like your salary, gets hit by progressive income tax rates. The more you earn, the higher the rate. But income from capital, things like profits from selling stocks, dividends, selling property, that often gets taxed at much lower rates. There are special capital gains rates, loopholes, exemptions.
And the super rich get most of their income from capital, not salaries.
Precisely. So the richer you get, the more of your income comes from capital, which benefits from those lower rates, pulling your overall effective tax rate down.
So the game shifts again. It's not just about owning the factory or mastering debt anymore. It's also about influencing the tax structure itself to protect those massive capital gains.
It becomes another layer of strategic control.
Yeah.
Okay, so if the 19th century was about physical stuff like steel and railroads, and the 20th century pivoted to financial leverage,
right,
then the 21st century, well, it's increasingly looking like it's going to be defined by algorithms and data. Yeah. Data as the new capital. And the engine driving this, the core technology, is deep learning.
Deep learning. We hear that term a lot. Can you unpack it a bit? What makes it so revolutionary?
In simple terms, it's an approach to artificial intelligence that's been incredibly effective at allowing machines to learn complex patterns from massive amounts of data. It's basically turbocharged AI's ability to do things that seems like science fiction just a decade or two ago.
Like what kind of things?
Well, programs using deep learning can now consistently be humans at specific tasks, like recognizing faces in photos, understanding spoken language, even things like analyzing medical scams or deciding who gets a loan based on complex data points. The revolution isn't coming. It's happening now.
And this technological leap has kicked off a huge global competition, hasn't it? Particularly between the U.S. and China.
Oh, absolutely. It's a massive geopolitical race.
Okay.
The sources we looked at sort of lay out a scorecard. Right now, China looks really strong, maybe even co-leading in areas like internet AI, think recommendation engines, social media algorithms, and perception AI, like facial recognition and surveillance tech. They're also catching up fast in autonomous AI, things like self-driving cars. The U.S. still seems to have a clear lead, mainly in business AI enterprise software, tools for optimizing internal company processes, that kind of thing.
And the economic consequences of this race, especially for developing nations, they could be huge, right?
Potentially devastating. One of the big worries highlighted in the sources is how AI-powered automation in factories could completely undercut the main advantage many developing countries have relied on for decades: cheap labor.
Because robots don't need low wages.
Exactly. If you can automate a factory almost entirely with robots, you don't need to locate it where labor is cheapest anymore. You're more likely to move it closer to where your customers are, back to the developed world, probably just to save on shipping costs.
So it pulls up the ladder that countries use to climb out of poverty.
That's the fear. It could create this widening, maybe even permanent, gap between the global haves and have-nots, cutting off that traditional path to development.
That's pretty bleak. But AI isn't just about replacing jobs, is it? There's potential for good, too.
Definitely. Especially with that business, AI, applied to public services. We're seeing real examples now where AI algorithms can diagnose certain conditions from medical images like pneumonia from X-rays or skin cancer from photos as accurately as, or sometimes even better than, human doctors.
So that could dramatically increase access to diagnostics, especially in remote areas.
Exactly. And in finance, too. AI is being used, for example, in China to offer credit to people who are traditionally ignored by banks, right. Young people without credit history, migrant workers, by using different kinds of data to predict risk instead of just relying on old-fashioned collateral. And apparently, these programs are seeing really low default rates, like in the low single digits, so it can actually expand access to capital in new ways.
Okay, so turning to the companies building this future, Silicon Valley, people like Mark Zuckerberg, did they use similar empire-building strategies to the old industrialists?
In some ways, yes. Especially that relentless focus on eliminating competition and achieving dominance, but adapted for the digital age. Growth over profit was key.
How did Zuckerberg show that early on?
Look at Facebook's initial expansion strategy. He didn't go for the easy targets first. He specifically chose to launch Facebook at universities like Columbia, Stanford, and Yale.
Why them?
Because those schools already had their own popular, established social networks. It was a deliberate market test. If Facebook could go in and crush the existing competition in those tough, mature markets, he knew it could win anywhere. Ruthless efficiency and market capture.
And that focus was echoed by investors too, right? Like Mark Andreessen?
Oh, yeah. Andreessen famously said something like, focusing on anything other than establishing a global franchise is a waste of time. That became the mantra.
Build the user base first, worry about money later.
Exactly. Zuckerberg explicitly followed that. He delayed the Facebook IPO for years, long after they could have gone public, because the priority was absolute market dominance, getting everyone onto the platform. Growth first, revenue second.
And this intense focus on growth and metrics spreads, doesn't it? Like when Facebook bought Instagram?
Right. The Instagram founders, initially, were actually wary of Facebook's obsession with metrics. They specifically decided not to focus on time spent on the app as a key metric.
Why not?
Because they'd seen where that focus had led Facebook towards more addictive, maybe less healthy engagement patterns. They wanted something different for Instagram.
But did that last?
Not really. The sources suggest that Facebook's intense measurement culture inevitably seeped into Instagram anyway. The constant focus on data, on analyzing trends, on giving users all these metrics, likes, followers, engagement rates.
It changes how people use it.
It seems to. It blurred that line between just being a person sharing photos and being a brand managing your online presence. Communication becomes less spontaneous, more strategic, more performative. It's the data-driven hustle culture becoming the norm.
Yeah.
Okay, so you've built the empire, whether it's railroads or code, but there's this final, really crucial piece. Controlling the story, controlling perception.
Managing the narrative.
Exactly. Doesn't matter if you're a 19th century tycoon or a 21st century tech CEO. Controlling the media narrative, how people see you and your company, is fundamental to keeping power and avoiding trouble.
And the old media moguls, they were masters at this. William Randolph Hearst. He didn't just report news. He used his papers like weapons, right?
Absolutely. As a tool in business deals. There's a great example when Hearst was trying to pressure Paramount Pictures, specifically Adolf Zukor.
What did he do?
He told his guy, Joseph Moore, to go deliver a threat, basically. Moore was instructed to tell Paramount they needed to wrap up negotiations right away, and it could be, quote, in friendly or unfriendly way as they see fit.
And the unfriendly way.
The threat was explicit. Choosing the unfriendly way will give them the biggest expose they have ever had, with civil suits and possible criminal prosecutions with the assistance of the government.
Wow. So cooperate or I'll unleash my media empire to destroy you legally and financially, maybe even get the government involved.
Pretty much. It was absolute leverage through narrative destruction, an offer they couldn't easily refuse.
And Robert Maxwell, the British publisher, he had a similar view of the press.
Yeah. Maybe a bit more cynical, or at least more colorful in how he put it. He had this famous quote about his relationship with journalists.
What was it?
He said, I have one gold chattel, which is a flipper, and one silver chapel. Depending who it is, I strike him with the gold chapel or with the silver chapel.
Gold and silver slipper. Meanings?
Meaning he treats them based on what works for him. Sometimes reward, sometimes punishment. Another version of his thinking was simply, everyone has his price. For Maxwell, the press wasn't about truth. It was purely transactional, a tool to be bought or used as a weapon.
And this kind of top-down narrative control, we see it in modern media, too, like Roger Ailes at Fox News.
Definitely.
Yeah.
Ailes was known for imposing strict editorial mandates.
Yeah.
After the 2006 midterm elections, which were a setback for Republicans,
Yeah.
Ailes told his whole team, essentially, doesn't matter what happened, put on a winning face. The narrative had to be one of strength, regardless of the facts on the ground.
And that kind of pressure from the top, it shapes the whole culture.
It absolutely does.
Yeah.
The sources describe a culture where executives were constantly trying to out-Roger, basically trying to be even more aligned with Ailes' perceived views than Ailes himself.
Leading to some pretty harsh stuff.
Yeah, exemplified by that shocking comment someone reportedly made while watching footage of Hurricane Katrina survivors. Look at these people. What do they think the government is supposed to come bail them out? It shows how a mandated political narrative can just completely override empathy or objective reporting.
And this careful image management, it extends beyond news into things like philanthropy, too.
Oh, for sure. Giving money away isn't just about charity anymore. It's often a strategic perception play. Look at Oprah Winfrey. She's done incredible philanthropic work, no question.
Right.
But even her own cousin offered this kind of clear-eyed take, pointing out that, well, The giving often lines up nicely with when Oprah needs tax deductions. And, quote, she doesn't bang a nail for habitat unless her cameras are running.
So the giving has to achieve multiple goals: the good deed itself, the tax benefit, and crucially, the positive publicity. It's performance.
Exactly. It's a transaction that has to burnish the brand, which is maybe different from the colder, quieter control of some earlier tycoons. Public performance is now part of managing massive wealth.
There's also an interesting irony mentioned regarding someone like George Soros, right, about his intellectual side.
Yeah, it's fascinating. Soros has always been deeply interested in philosophy, trying to understand markets and history through these broader frameworks. And his critics often point to this as a distraction.
Saying he should just focus on making money.
Right, lamenting his need to be this philosopher king instead of just a financial speculator. They saw it as a weakness.
But the sources suggest maybe the opposite.
Exactly. Paradoxically, it might have been his strength. That deep philosophical drive, that yearning to make sense of the world, is what forced him to constantly question his own ideas about the market. It made him acutely aware of his own fallibility. He wasn't dogmatic. His real genius in finance, arguably, was his incredible ability to recognize when he was wrong very quickly and then reverse his position immediately, cut his losses without ego.
So the philosophical side made him more self-critical, which was key to his financial success.
It seems so. That intellectual humility, born from trying to understand big, complex systems, turned out to be maybe his most valuable asset as an investor. It shows that even in the hard-nosed world of finance, that human element of reflection can be decisive. Hashtag outro.
Wow. Okay, so pulling this all together, this deep dive, it really does show some clear lines connecting these different eras, doesn't it?
Absolutely. The pattern feels pretty undeniable. These huge empires of power, of wealth, whether they were built on railroads back then or junk bonds in the 80s or neural networks now, they all seem to boil down to a few core, often pretty ruthless mechanisms.
Leveraging something unique you control.
Right, whether it's monopoly on logistics or access to massive debt or proprietary algorithm nobody else has.
And then combining that with just relentless focus.
Yeah, focus on efficiency, on control, on growth above all else. And crucially, the ability to synthesize information fast and, importantly, control the narrative, control the story.
That absolute focus on efficiency, on optimization, it seems like the defining trait. But now, as we start handing over more and more decision-making to AI, which is the ultimate efficiency engine, does that create a new kind of problem?
It really does. It brings up this deep, almost philosophical conflict. We should think about Kai-Fu Lee, the AI expert we mentioned.
Right, his personal experience.
After he recovered from cancer, he talked about how that changed his perspective. He said he could no longer look at huge societal challenges, like the potential for mass unemployment due to AI. He couldn't see them purely as simple resource allocation problems to be dealt with in the most efficient way possible.
Because efficiency isn't everything.
Because he realized, through that personal crisis, the absolute centrality of things like love, compassion, human connection, things that AI can't quantify, can't optimize, maybe can't even understand.
So that leaves us, and you listening, with a really big question, doesn't it?
A monumental one. Can those hyper-efficient, sometimes ruthless mechanisms that have always built empires, the same drive that fueled Rockefeller, the same optimization that powers deep learning, can that mindset ever truly coexist with or be guided by something like compassion?
Or will efficiency always win out? What does that mean for how we choose to use AI? What should we even be measuring as success if the most efficient outcome might be, well, morally empty?
It's a conflict to really sit with. Maximum efficiency versus human values. Where do we draw the line?
Definitely something to keep thinking about. Thank you for joining us on the deep dive. Go forth and apply this knowledge.